What do you make of the turnaround in sentiment that we've seen just in the last few hours and that brutal sell-off yesterday? What it tells us about market dynamics and particularly financial conditions?
Well, I think what it's showing more than anything else is that there's still a great deal of uncertainty about the near-term trajectory, both of inflation and of growth. And so we're seeing a lot of volatility, understandably a big drawdown every time investors get worried about the risks to growth. But of course, we have seen quite a big correction now, and there are inevitably times when you're going to get some of the setback rebounding again, as we're seeing at the moment. I think, though, that it is important to emphasize that we have seen a huge absorption of a lot of worrying things for investors now. The significant rise in inflation and interest rate expectations. Bear in mind, a year ago or so, the expectation was there would be no rate rises this year in Europe or the US. Secondly, of course, the war. And thirdly, growing concerns about growth. So all of that really is absorbed into the market already. The question is, where do we go from here at the margin?
Yes, does that make this a buying opportunity then, Peter? If you describe it as absorbed already, does that mean it's priced in, those concerns around higher interest rates, around inflation, around the war and around growth? If they're priced in, does this represent a buying opportunity?
Well, I think, Anna, that really depends on your time horizon. If you're taking a sort of 6 to 12 month view, we would say, yes, it is. We do expect lower returns across all financial assets in this cycle, given that we're not likely to see the tailwind of lower interest rates. But equities are starting to look attractive for medium to longer term buyers. First of all, we have negative real rates, and equities are a hedge against inflation. They're making a claim on nominal GDP over time, and that's, I think, a positive. Secondly, we've seen a huge worry about inflation, and it's risen sharply, but we're getting relatively close to the peak of year-on-year inflation, and that will start to provide some relief. Thirdly, and you mentioned this earlier in your program, earnings actually have been very strong in the last quarter, much better than many people expected. And that's been pretty true across the US and Europe. So earnings are holding up reasonably well. And fourthly, and importantly, valuations now have come down quite sharply, particularly outside of the US. You know, Europe is trading at around 11.5 or 12 times PE, well below its long run average. That's true across Asia and EM. UK is trading at around 10.5 times earnings. Dividend yields are high, balance sheets are strong. So there is some support, I think.
OK, some examples of potential support out there. Let's stick with that 6 to 12 month time horizon then, Peter. Where would that take you on a sector-by-sector basis? You talked about the ability to hedge within equities. Does it take you into healthcare? Does it take you into utilities, energy? Or do you want to be more bold and look even to add technology at this point?
Well, we have been quite strongly in favour of value sectors for some time now, believing that higher inflation expectations and higher rates would generally lead to a derating of the longest duration parts of the market, which got very expensive, and provide some relief for those laggard areas from the previous cycle. But I think it's increasingly the wrong way to look at the market as a sort of prism of the split between growth and value. We see that there's value beginning to emerge across a range of different sectors now. And we would have a much more sort of balanced and diversified approach. We do think that high energy costs and high labor costs are going to lead to more investment in energy and labor efficiency, and that will benefit some technology companies. But at the same time, we believe you're going to see more fiscal spending, particularly in Europe, more incentive for companies to increase capex after many years of a pullback in capex spending, and that should benefit a lot of industrials. So I would have a little bit of a balance across these different types of factors.